Welcome to AT&T's teleconference service. Please enter your access code, followed by the pound sign. To join the conference as the host, press star. Otherwise, press pound. Please enter your host password, followed by the pound sign. There are 1 participants on the call, including you. You are joining your conference as the host. For a menu of available commands, press star pound.
Conversation, so let's call to order the Defined Contribution Committee meeting.
Good morning, Mr. Chairman. Have a market update. Our representatives are from Callan are here. They're going to give us a market update on the MDC and ORP programs. Alex?
Great. Thank you. Good morning, ladies and gentlemen of the Defined Contribution Committee. Good to see you all. Please, I'll address the elephant in the room. Excuse the general appearance of my head. I had an unfortunate scooter accident over the weekend, went over the handlebars, took a little chunk out. I'm okay, could have been a lot worse, but I have to wear a Band-Aid for about a week. So With that out of the way, it's great to see you all. Hope everyone's having a nice summer so far. We have an update that includes a little bit of a market review. Now, we're in one of those environments where essentially as soon as we're printing material, it's becoming stale. This is a quarterly update, so it's through the end of March, and as I'm sure you're well aware, quite a lot has happened since then. Thankfully, the defined benefit overview is going to cover some of the intervening months through April and May, so we'll be able to touch on all that's transpired since then. But yeah, we're going to step a little bit back in time. But please stop if there are questions along the way. Happy to dive in deeper. If you have the MDC book, we'll ask that you turn to page 19. This is called the asset distribution. It really shows kind of what happened over the period of the first quarter. And we can really tell a lot from the market environment if we look at the investment return column. You'll see some splotches of red, particularly within the domestic equity market segment. That was reflecting a little bit of a sell-off that started to take hold as the end of the first quarter approached. Some of that was valuation driven. A lot of that was anticipation of the tariffs. As the quarter kind of wound up, people knew that was coming. It wasn't officially announced until April. But again, in anticipation of that news, markets started to sell off. So the S&P 500 had its worst quarter of performance in a couple of years. Since the third quarter of 2022, it was down just shy of 5%. As a baseline, from there, large cap growth, so think, mega tech and so forth, did a little bit worse, and smaller companies did worse as well. Again, they were responding more to the remaining high interest rates, and these are higher leveraged businesses, so they struggled in that environment as well. Equity, as you can see, accounts for over 50% of the MDC. And so went that market, so did a lot of the participants. But there are other pieces as you go down the page, and the theme of the first quarter was diversification really paid off. So international equity was actually positive while the US market sold off. Fixed income was positive. And then at the top, money market, stable value, all positive. Most of the target date funds themselves were also positive. Those that still have many decades to go have a lot more risk, a lot more equity, a lot more US equity, and you'll see slight losses there. But as you can kind of tell from this page, there were some challenges in the prevailing market environment, but there were other pieces that counteracted that. And so again, bringing together these blended portfolios really benefited participants. All told, the investment return on a dollar weighted average was just over 50 million in losses and over 33 million flowed out. So that's what accounted for the relatively modest decline in the value of the MDC at the end of March. Now, I will just say, and we'll see a little bit more about this in a minute, that was one quarter. And certainly, a painful quarter for some participants, but this follows 2 years, 2023 and 2024, when the S&P was up 25% each of those years. So we're going to kind of come back to that idea of the longer term view blended with what's happened more recently. If you flip to page 20, we can start to see what the performance looked like on a fund level. At the top of the page, principal protected, the stable value offering is about 20% of assets. This has been a nice stabilizer, the anchor to windward in these bouts of volatility. But something we've touched on is if you look at, say, the last 3 years, a 2.69% return annually has struggled to keep up with the money market fund just below it. That is not something we expect long term, really a short-term market anomaly because rates remain so high on the short end. So cash account yields have been among the best places for fixed income relative to, for example, a stable value that has a little longer duration. We do expect that to kind of unwind as the yield curve, quote unquote, normalizes. Still has been a nice, bastion of safety for those allocated there, but a theme that we've touched on a little bit over the last couple of years. More in the middle of the page, I'll call out a manager that has developed a more nice turnaround story, Loomis Sales, large cap growth. For a while, their performance had been challenged, but you'll notice now that over the last year, 3, 5, and 10 years, their returns over most of those periods are now in excess of the benchmark, and equally importantly, in what has been a very hot market segment, they are ranking really well against other funds in that space. So that's the opportunity cost question. If you weren't with this particular manager, you were with someone else, how would you have done? And their ranking indicates that they have remained a solid choice. So again, this goes back to the patience that staff has had in monitoring and that the committee has had in the oversight of a fund like this. A lot of numbers on this page, but I think that the key takeaway for the committee is if we say scan down from top to bottom that last 3-year column, what you notice is that virtually all of the funds, with few exceptions, are in excess of their respective benchmarks. Now, the absolute returns vary quite dramatically depending on what market segment they are targeting, but measured against an appropriate yardstick, each of the managers is doing quite well. And so from that high level 30,000 foot view, we would argue that things are working by and large as we would hope for the MDC in terms of investment performance. And really, no easy challenge when we think about the last 3 years. Been tough for active managers. The markets have been quite volatile, up and down. So to see this, I think, again, a pretty solid report card for the MDC. Quickly on 21, just a comment about the target date funds. This has been a wonderful test case for this type of fund, the set it and forget it option. Right? This is professionally managed. It de-risks over time, so it lessens the amount of equity, increases the amount of fixed income as retirement approaches. And it gives diversification to participants automatically. These are performing very well. And you'll see, for example, over the last quarter, those at the top of the page have much less risk, much more fixed income, generated positive returns, while as those at the bottom of the page with much more equity saw slightly negative. So you're seeing kind of that play out as the market environment kind of dictated. And that flips over the last 5 years. Those at the top of the page, by design, less risk, lower returns, whereas those at the bottom of the page have a return 2 to 3 times, reflecting the much higher risk level in there. And lastly, on page 22, a quick touch on fees. And so, from your seat and from staff's efforts, been able to maintain a very cost-effective implementation for participants in the MDC. That's important. I said on the last page that performance results are, by and large, looking great, but that's totally out of our control. Right? We don't know what the market's going to do, and we don't always know how managers are going to respond, but what we can do is exercise the scale of the MDC to try to bring costs down as much as possible. That's the known variable here. Suffice it to say, if you go to the bottom line of the table, the dollar-weighted net expense ratio of the MDC comes in at 25 basis points. So that sounds low, and indeed it is. But as a way to benchmark that, if you were to have all the fund options kind of priced at the median of the marketplace, the fee would be closer to 80 basis points. So more than triple. That equates to about $14 million a year at current levels that, again, kind of remain in participant accounts, compound over time, as opposed to flowing out and going to pay for funds through the investment managers. So, again, this is another very solid report card for the MDC.
Any questions
Any questions?
before?
Yeah, I have one. I would, back on page 20, real estate had been for the last year or so challenged, but I was thinking it was turning around a little bit. But evidently, according to your figures here, it's still a challenge. Real estate has just not been good. Is that correct?
So certainly, real estate has been challenged. That is a great thing to point out because when we look at the ORP, we're going to see the two different ways to access the real estate market. In the MDC, these are REITs. They are equities. They trade on an exchange. They're much more volatile, and they're going to respond much quicker like equities. You've seen over the last year, they at 11.55 were among the best fund options in the MDC. So they are responding very quickly to what people assume is the bottom of the market at this point. But the last 3 years, they were one of the worst performing funds. And that's because that's reflecting, to your point, the massive challenges in the commercial real estate market. So they're responding quicker than private real estate, which we're going to look at is a fund option in the ORP.
Thank you.
ORP.
Okay, wonderful. So the ORP is in a separate book. And we'll hit the high level points. On page 2, just a quick check-in on how the total ORP is split. There are 3 providers, Corebridge, Voya, and TIA. This remains steady quarter to quarter, year to year. TIA owning over 50% of the ORP, $1 billion, followed by Corebridge and Voya. They each have their own distinctions, which is going to be the bulk of our comments coming on page 5. Or no, excuse me, that's the annuity platform on page 10. This is the live mutual fund platform of Corebridge. Follows a very similar theme as the MDC. There are differences in the way the participants utilize the plan. So domestic equity makes up a far smaller percentage at about 38% of total participant assets. Target maturity, slightly higher at about 20%. In an environment like we saw in the first quarter, obviously that's going to influence the participant outcomes, right? The much more equity-heavy plan is going to see greater unrealized losses than this one, which comparatively is a little bit less risky. Okay, now when we're going to check in on Voya and exhibit some of their differences on page 21, you'll see the way that the participants access and utilize this plan is much more similar to the MDC, particularly when we look at that equity allocation at over 55%. Much more risk embedded in this plan. Another difference that becomes helpful is on 22 when we talk about the target maturity, the target date funds. Whereas the MDC and Corebridge use Vanguard in a purely passive implementation, here through T-Row, there is a component of active management. And that's very important because if you look, for example, over the last quarter, each of the vintages was able to deliver return above the benchmark and above kind of the average of the marketplace in most cases. And so that is the active management showing its value at times, being able to protect investor capital to the downside. So this is an environment where that has really paid off. And then last but not least, we're going to check on TIA. On page 27. And this plan is much more diversified across the fund options, fewer concentrations in any one asset class broadly. And this is by far the largest of the 3 plans. Now, under real estate, and we'll look at the performance in a moment, you'll see TIA real estate, about 3% of assets. This is unlike what we just talked about in the MDC. This is much more akin to what you get in a defined benefit plan, where they're not listed traded real estate securities, but owning a fund that owns actual buildings, like we do with core real estate within the DB plan. So it's a different way to access the market. The performance pattern is going to differ, as you'll see if we flip to page 29.
Deferred comp has outperformed both of them, except for that last quarter of the TIA.
Right. So yes. So part of the problem is the one we talked about in MDC, equities listed, traded throughout the day. This is much more appraisal based, so it's going to respond both to the upside and downside much slower. The good news is that, you know, by all accounts, we are getting very, very close to the bottom of kind of the real estate write-down cycle. Now, we may not be there yet, but managers will come and tell you that. Our research seems to support that conclusion. So this type of allocation is primed for potential stronger returns going forward, and we think that that could benefit investors in the TIA platform who use it, right? So it's not going to respond as quickly as listed REITs, but over the long run, we do think that it could have a really nice differentiated return stream for these participants who use it. You know, somewhere between the equity and bond expectation. So that's what sets this apart relative to the other two. Again, all told, whether it's the MDC or the ORP, given kind of the volatile market environment, things are performing, you know, as we would expect. There's nothing from our monitoring that looks broken or needs to be immediately addressed. So we're happy to see that those things are functioning as designed.
In spite of what we hear, all this doom and gloom, evidently we're doing okay.
We would say so. Yep.
Any other questions on MDC or ORP? Okay. Plan document.
All right. Thank you, Mr. Chairman, and members of the committee. I would like to ask for your review and approval of revisions to the ORP plan document. You should have that in your packet. This particular recommended revision, as we come back to you, is to make changes to update due to changes in state law, either from last session or the session from a few months ago. You can see those changes before you, but to summarize those, it leaves the participant contribution at 9%, and as far as the employer contribution for those hired before July 1st of 2025, it would be at 14.9%. For those hired after July 1 of 2025, it would be up to 9%. And the change in law also allows for the board to be able to set, for administrative fee purposes, an amount up to 0.2%, the 0.2%, as you see reflected there, and the remainder going to the UAL. And so, like I said in the beginning, this is largely to update for changes in state law. We also have corresponded and met with IHL to confirm that the amounts, because the new law did provide for the option for additional employer contributions, but in working with IHL, we've confirmed that the amounts for the upcoming year will be consistent with the statute. So at a later time, just for information, I do think it would be good for us to make a more comprehensive review of the ORP plan. Some questions come up throughout the legislative process. So at some point, when we finish up with Tier 5, I think it would be good for us to review that. But for today, this recommendation is to comply with changes in state law, and we'll be happy to answer any questions, and otherwise would ask for your approval.
Is this the one that goes on the schedule that ends up being like 19-something%? Is this that part?
Well, it's related to that. It's ORP. It was prior to the law, and I guess still is, was tied to the PERS contribution rates.
That's what I thought. Okay.
Is there a motion to approve these changes?
So moved.
There's a second.
Second.
All those in favor say aye.
Aye.
Any opposed? And the motion carries.
Thank you.
Any other business for this committee?
That is all we have.
Okay, then we are adjourned. Thank you.
Thank you.
So we are at the investment committee. And first thing that I believe that we have is a market update, but I'm going to turn it over to you, Charles, for any comments you want to make prior to turning it over to Calvin.
Thank you, Mr. Chairman. Just to kind of give you just a few opening comments following up on, from when we met last time. Following the broad market sell-off that we saw in March and in early April, that was mostly driven by intensified rhetoric around tariffs, global equities rebounded strongly. The turnaround was fueled by news of a trade agreement with the UK and tariff truces with both China and the EU. This shift in market sentiment sparked a sharp rally in the S&P 500, which gained 6.3% in May, its strongest monthly performance since November of 2023. In the U.S., economic data pointed to improving conditions. The manufacturing PMI climbed to 52.3. This signaled a return to economic expansion. April CPI rose 2.3% year over year, slightly lower than the previous month. This suggested easing in inflation pressures. The Federal Reserve held interest rates steady in May, as expected, reaffirming its data-dependent stance. Meanwhile, unemployment rate held firm at 4.2%, highlighting continued strength in the labor market. Growth stocks led the way in May, with the Russell 1000 Growth Index advancing 8.8%. International equities also performed really well, with the MSCI and the MSCI Emerging Markets Index returning 4.6% and 4.3% respectively. The PERS portfolio for May returned 3.25%, and as of June 23rd, the portfolio is up nearly 1.25% month to date, with an estimated fiscal year to date return of 9.84%. So basically, with the recent market developments, this really reinforces why it is very important that we, stay disciplined and committed to our long-term strategic target allocations and not allow market insecurities to push us around. So with this, I'd like to hand it over to John and let him go through their report on our performance. Thank you.
Thank you, Charles. Good morning, everybody. We're going to spend a few moments talking today about performance through May 31st. You may recall back in April when we met, we talked about the challenges in the marketplace, a sluggish first quarter, a volatile month of April as it was shaping up to be, and we thought we had better news on the horizon, and certainly that's been the case. When we look at the highlights that you'll find on page 4 of the book with the white binder, you'll see that the total fund assets stood at $35.1 billion at the end of May. And this is an increase of approximately $1.2 billion from the end of the first quarter. Again, an increase of about $1.3 billion in investment returns, and then net outflows reducing that amount by about $142 million. Asset allocation continues to be in line with targets within 2 or 3%. We see underweight allocations to domestic equity. And again, the theme that Alex laid out as we looked year to date, we saw that the U.S. equity assets were lagging their non-U.S. equity peers, as well as challenged in terms of the first quarter negative return, as well as the April return was modestly negative, and then we saw a big bounce in May. Short-term performance, as you see the chart below, this has got the listing by asset classes. And again, what I would highlight here is you look for the short-term period, the 2 months since March. We see domestic equities, that green bar to the far left, up about 4.4%. You scan over to international equity, up 9%. Fiscal year to date, that's the next part in, the dark blue for domestic equity was up 7.6% on a fiscal year to date basis. International equity up 15%. So again, the benefits of diversification are really at play here. We've seen an extended period where non-U.S. equities have been trailing the exceptionalism of the U.S. equity market, and we've seen a turn somewhat. When we look at the fiscal year to date for fixed income, we see that it's at a healthy 5%. Real estate at 3.8%. That would be private real estate. Private equity up about 7%. Private credit's up 6.7%. And then cash at about 4.7 year to date. So if we look to the far right, we see the highlighted by the dotted orange line. We see that the fund return over the last 2 months was about 4%. Fiscal year to date, up 8.5%. And over the last 1 year period, 12 months, 9.4%. Over the very long term, we see continued success from the fund. It's outperformed the benchmark over the 5, 10, and 15-year periods with annualized returns of 9.9%, 8.1%, and 9.3% respectively. So again, strong performance overall. We're going to jump into some of the details behind the markets, but again, the idea here is that a diversified portfolio, certainly we saw the benefits on the international equity front on a fiscal year-to-date basis as well as a calendar year-to-date. I'm happy to stop there with any questions. If not, we can turn to the markets.
I would have a question about the inflation rate, or actually what the Fed is going to do for lowering it. It seems to me between the president, the chairman, and some of the governors, there is a little bit of disarray as to whether, the chairman, as I read, was saying we're going to see increased inflation. One of the governors said, well, next meeting it may go down, and of course, Trump's calling people names. But what does Callan perceive? What does your crystal ball say about that?
Well, we don't have a crystal ball, but I'll tell you what our observations are from the market standpoint. There's certainly a lot of uncertainty in terms of policy changes and their effect. And when we see the announcements of tariffs, initially the reaction was that was going to increase inflation and stifle growth, only to turn again in May, where we saw that there was a pause. And whether the long-term game with respect to the tariff use is it for negotiation? Is it to level the playing field? Is it holding partners accountable to be a fair player in the international marketplace? And if that's the goal and the strategy is bargaining to hold them accountable, that's a different perspective than we're looking for long-term bringing manufacturing back to the U.S. We are going to increase the rates independent of what the shorter-term impact has. So difficult to divine what the particular strategy is, but what we've seen the market react was initial announcement of the tariff policy versus the pauses, the negotiation that took place where that was embraced by the market to a greater extent. So what about the Fed? What is their perspective? They see that if tariffs are going to be in place for the long term, they see that as inflationary and may have an impact on stifling growth in the shorter term, right? So they have a dual mandate. Unlike some of their foreign counterparts, they're required to have stable employment and to maintain a consistent pricing mechanism. Well, inflation's at 2.4%. It's sticky. And while the target was 2%, most people would think you're not going to get down to 2%. At this point, at 2.4, over the long term, it's going to take some time for it to even gravitate down. With respect to growth, we saw the first quarter was modestly negative growth. Again, as the perception was that people were going out in advance of the tariff policies, there was quite a bit of purchases of imports, which has again, a stifling impact on growth. But then we see some of the estimates coming out of the Atlanta Fed, for instance, for the second quarter, they're saying, well, the consumer is resilient, drives 70% of GDP, and we see that GDP estimated for the second quarter maybe as much as 3.8%. So again, what's occurring? Are we experiencing a slowdown in growth, the potential for a recession, and an increase in inflation? No. So the Fed is sitting there looking at this saying, okay, what is our case to cut the rates in the short term? Do we see that growth is declining to a level that we need to spur activity by cutting rates? No, and they've stayed pat. So they've both for the most recent meeting in June, they said it's data dependent. We're going to watch what the market does. What they're describing is the uncertainty surrounding what the tariff policy is going to ultimately be. They're describing it, we're going to wait and see what actually gets implemented, what actually happens. So from that standpoint, it's a lot of uncertainty, but not altogether bad in terms of the fundamentals of the market. What we have is 4% unemployment. Well, that's a terrific number. At 2.4%, 2.3% inflation, 2.3 in April, 2.4 in May, still benign, right? So you don't see necessarily the fundamentals saying the same story as opposed to what the headlines may be portraying or what the potential is. And so from that standpoint, it's not altogether surprising that you're going to have constituencies with different perspectives as what's taking place. So the Fed is standing pat until it sees something that requires action. There's a thing called the dot plot, which is a survey of the members of the Federal Open Market Committee. And what we've seen is, they're half the group that was voting is still anticipating 2 cuts within the year. Well, there was more than that at the beginning of the year, so before the implementation of any tariff policy. So again, what you have is an eye towards, okay, at some point, we may need to cut rates, but do we need to do it immediately? Not so much. And so that tells you where the different parties are coming from.
With respect to the tariffs, have any of the major trading partners actually settled the tariffs? I get confused with all the changing news. Have any of the major trading partners, have that been settled with them?
So there has been an interim placement of tariffs that have been implemented, but I mean the big policy changes are with respect to what ultimately is going to happen with China is a big deal. That pause not only benefited the U.S. markets but also the Chinese markets in terms of a softening of the position, an agreement to say, okay, let's take some time and figure out how to implement that. Increases have been embraced, but not to the full extent that was initially announced. So, and until the ink's dry, you kind of hesitate to see what exactly is going to happen, right? So, I mean, the good news is the economy is sound, performing well. The fundamentals are strong. Consumer sentiment that again aided in the April was a market where the S&P was down as much as 11%, and then we saw that it bounced back and to the point that it was actually positive for month end. So again, we saw that, you know, you take the news into account, you ride the market, but at the end of the day, it's staying disciplined to your allocation strategy. You continue to rebalance judiciously in a cost-effective manner. And a lot of this is going to be the risk that's built into the economy.
So the president's initial tariffs, by and large, are standing on the countries. In other words, what he said, he didn't pause all those, but the Chinese, he's kind of eased up on them a little bit, but the rest of them are still paying the tariffs right now.
I would say they're all, they're still under negotiation until to see what the final is.
Okay, so they're not paying what he released in that press release that everybody gets a 50% tariff for. You know that list he showed?
There was an agreement with the UK, so the UK is paying what was agreed upon. But in an effort to work through and bring the rhetoric down a little bit, he put a pause on the real high tariffs that he placed on the EU as well as China. So may still happen, but we'll see.
With respect to, if we look at page 5, again, this is showing the different asset classes and how they've performed. What you see is if you look fiscal year to date to see how we're doing, you see that the non-US, which is indicated by the red bar, is up 13.7%. And we see that the Russell 3000, which is your US equity index, was up 9.7%. So diversification over the fiscal year to date certainly has benefited. Over the last 3 years, you see that, again, it's almost the opposite, where we see the Russell 3000 was up an annualized 13.8%, and non-US stocks were up a little bit over 9%. So again, both equity markets been performing strongly. As we see over the last, the calendar year to date, that 13.8% certainly aided by a weakening dollar during that period of time. U.S. Fixed income, and this is where for the calendar year to date, about flat over the Bloomberg aggregate. We see, again, over the last calendar year to date, 2.4%, fiscal year to date, about 4.5%. So again, fixed income being relative, it's kind of that anchor to windward in terms of holding up. Turning to the equity markets on page 6. So equities rallied in May, and we see that the Russell 3000 was up 6.3%. So again, that puts the year-to-date in a positive and a fiscal year-to-date at 9.7%. So what we saw in the first quarter, we saw what had been leading the charge in the U.S. equity markets for the past number of years has been the Magnificent Seven, right? Information technology, artificial intelligence. That had been driving the market to the tune of the S&P 500 was up 25% for 23 and 24, right? So again, if you put it in perspective, that's 2 years of 25% gains in the U.S. equity markets, and if you went back to 1926, the average is about 10.5. So again, extraordinary strength, this exceptionalism from the U.S. equity market, but very concentrated in a select number of stocks. In the first quarter, I guess if you looked at year end at 2024, you'd say U.S. equities are priced to perfection. And the issue with that is if anything throws a wrench in that or creates a level of uncertainty, then you're going to see a sell-off. And that's exactly what you saw in the first quarter. The stocks that were leading the market up until that point were those that performed the worst. So information technology, AI, the Teslas performed poorly. In the month of May, we see, again, a calming of the jitters in the market, and we see, again, a turn with the leadership of information technology stocks outperforming. as well as when we look at communication services and consumer discretionary, namely, automobiles, think that. So if you look at the bottom charts, you see the strength, all but, I guess, we see that of the different sectors of the market, we see broad performance as we look at information technology up 10.9%. So that was a leader in the marketplace. And then we see consumer discretionary and communication services being up 9.8, 9.5% respectively. Healthcare stocks were down about 5%. Okay, so so the themes here we have is growth outperforms value. As you look at May, you see that the growth stocks were up the Russell 1000 growth was up 8.85% versus the value stocks that were up 3.5%. Again, when you think of growth stocks or the Russell 1000 growth, we're looking at about 46% as that information technology stocks. Within that, you see your Apples, your Microsofts performing extraordinarily well. Okay. Non-US stocks. Here we see that, again, more modest performance in the month of May. We see broad-based performance. So the ACWI US, that's your very broad, that contains both emerging market stocks, was up about 4.6%, fiscal year to date up 13.9. So again, strong performance here, aided by certainly the weakening dollar. As we look in emerging markets, the Chinese markets were up some 40% for the 1 year period. So again, that was really kind of driving that emerging market index. As we see, they were up over 13% over the last year. Developed market stocks, that's the EFA. Europe, Australasia, Far East was up about 15% over the last year. So those are developed markets. And we see, unlike US small cap stocks, non-US were up about 12.8%. So holding their own versus their larger cap brethren. Lastly, we turn to the fixed income markets, and we saw that there were declines in May. So again, what you had was inflation pressures that didn't really come to the forefront, elevated fiscal uncertainty. So we saw that the U.S. debt received a credit downgrade, concerns about the debt sustainability and how that was going to fare. So we saw that the Bloomberg aggregate, that's that broad investment grade index for the U.S., largely U.S. markets, was down 0.7%. In contrast, as investors, because the fears of an imminent recession abated, you saw them going out and embracing a little more risk. So high yield performing better, up 1.7%. Certainly volatility mixed with respect to the treasury markets. The 10-year gained ultimately 0.24%, going from, again, going to 4.4% for a 10-year bond. So again, the idea here is that the U.S. markets, again, are resilient. We saw a strong bounce back from the doldrums of the first quarter in April. And we see that, again, there is a great deal of uncertainty in the market due to geopolitical events and what ultimately is going to happen on the trade policy front. But suffice to say, as we look at the markets overall, some pretty good reports coming through. Corporate earnings are solid. Any questions? Okay, let's look at the brief performance. When we look at page 10, again, this is the actual allocation versus the target allocation. And we show, moving from left to right, the asset class, the dollar value, the percentage of total, the target, and then the difference in millions. And again, what I would say here is when we look at the domestic equity, given domestic equity has lagged some of the other asset classes, not altogether surprisingly, it would be a little bit below. So at 25% versus 27%. But all in all, would say that these are all within a striking distance of their targets, so no issues there. With respect to page 11, this is, again, a similar chart to what we saw that Alex presented, showing the, again, moving from right to left. We see the March 31 value, and then we see the investment return, and I'm going to highlight that column, and then the net new investments, which is your plus, minus, and transfers, and then you have your ending market value as of May 31st. As when you look down the investment return column, when you looked at the 331 report that Alex presented, you saw a lot of red numbers with respect to U.S. equities. Well, you can see all black here in terms of the asset classes generating positive returns to the tune of $1.3 billion. Ending value, a little bit over $35 billion. Any questions on that? Okay. Let's take a look at the asset class performance on page 12. So these next two pages, page 12 is the short-term performance, and then we see the longer-term performance is going to be on the subsequent page. So as we look for the 2-month period, last 2 months, we see that the fund was up about 4%, benchmark was up about 4.16. Difference here, I would highlight is, again, real estate trailing a little bit, but we saw it was the domestic equities at 4.3% versus 5.6. Major contributor is for the decline versus 6.04 versus 678 for global. We saw that our international equity managers outperforming, fixed income outperforming, real estate modestly below, private equity outperforming, and then private credit. Again, the newer investment, short period here, as we see that it was up 0.22% versus 1.6, but it only represents 0.35% of the ending value of the portfolio. When we look at fiscal year to date, good news is that we're north of 8% at 8.45, and over the last 3 years, a return in excess of 7%. We look to the next page and we see the 5, 10, and 15 years. And again, what we see here is solid performance over the last 5 years. The fund was up 9.9% per annum. Last 10 years, up 8%, and up 9.3 over the last 15 years. So strong performance there. When we look at the next page, this puts it in terms of how the fund performed versus its peers. And again, we're looking at peer funds with assets in excess of $10 billion. And again, the way to read this chart is that we look, the total fund is the blue circle. And when you look at the graph, the number next to the circle tells you what is its percentile rank. So we see that over the last year, performance at 5.51 trails the benchmark and trails peers at 66. But if we look longer term, we see that the 5-year return for the fund as of March 31st was 11.15% annualized versus 10.6. So again, this is different from the prior chart because we were looking at May. This is showing you as of March because we wanted to include that peer data. How did it look? And we collect the information on the peers each quarter, okay? So different period here, but again, the reports, as you look at the last 5, 7, 10, 15 years, you see outperformance versus the benchmark, and you also see ranking versus peers as being strong. So over the last 5 years, a 31% ranking means that you outperformed 69% of your peers with assets over $10 billion. Over the last 15 years, you're in the 17th percentile. So you've outperformed 83% of your peers with assets in excess of 10 billion. And the next page, just giving you a calendar year snapshot. And the idea here is that versus peers, 7 out of the last full calendar years, you've outperformed your peers. So that is covers the asset class performance, the total fund performance. Happy to answer any questions that you might have.
Questions from the board?
Thank you.
Okay, got one.
Overall, you did a pretty good job with the stock market influencing them. I just say that, I think that you did.
Well, as always, just keep in mind that if we're doing well against the market, then I'll take credit, and if it's not, then we give it to Alex over here. That's how it works.
Okay. All right. Carl?
Can I, Mr. Chairman, ask
Yeah.
one question? Okay.
Sure, go right ahead.
You may have covered some of this. This really goes more back to, I guess, more of the market update or market impact. But is any commentary from you or Callan you may want to provide as it relates to recent events in the Middle East, specifically in the context maybe of oil prices and going back to the earlier conversation about inflation and interest rates?
Sure. With respect to, events in the Middle East, as you see, oil prices increase, that you would see that, I guess, if we were to look 15, 20 years ago, where we were a greater consumer of foreign oil, maybe we would be have a greater impact in terms of the U.S. economy. I think it's certainly the uncertainty, very short-term in nature, and who knows, the news coming out, daily saying that there might be some longer-term solution to it. We know oil prices, given that, the Middle East is a big source, is always going to be volatile when there's geopolitical concerns and what that means from a, shipping standpoint. But the tough to make any determination with respect to what we think is going to have any lasting effects in the markets, because we're not really aware of what the long-term impact's going to be. So, yeah.
Sure. Thank you for that. I know we'd mentioned tariffs earlier. I was thinking of the recent stuff as well. Thank you.
Yep.
I think.
Other questions?
Well, I was going to say, I think that may be it. We have a little extra time this time around. If you agree, as a suggestion, assuming Charles and Jason agree, I was wondering, lunches are ready, but what we could do, we could go ahead and do the private equity preview. If you want to go through that, and of course, have any discussion with the committee, and then we could have lunch and have the managers come in as usual. But I just want to suggest that. If that works.
Charles, is
I'd
that
be
okay
agreeable
with the
to that.
schedule that you had? Is that okay with the schedule that we have? What time did you tell the first group to be here?
Well, we seeing that the agenda was a little bit, I wouldn't say lighter, but, there wasn't as much on it this time. We asked them to come early, so they're here. They should be here. But if it's agreeable to you, Jason and I would like to kind of go do a little primer on our private equity program. And then, because we have a really good lineup of some educational, material as far as private equity goes, from our private equity managers. So we just wanted to spend a little time and, talk about private equity and our program, just to kind of give you a little, primer to that.
Okay, do you want to do that before lunch, before we hear the introduction of those, or kind of what's that schedule you're saying or proposing now?
Well, if it's agreeable to you, we can do the primer now, and then after lunch, hear the managers, or it's fine with me, whatever way you would prefer.
Well, knowing that, or looking at in past what the primers amount of time, we might have time to actually hear at least one of the groups prior to lunch with a 25. That would get us closer to 11:30, 11:40, and then get the second one after lunch, and then any following discussions that you would want to have with us on the private equity and that sort of thing. So what does the board desire? I just hate for us to have lunch at 11:05. I feel like I'm back in school. I'd rather fill it up with, work. Here.
We could go ahead now with whatever we can get done and then have a short lunch and then do the second.
I think just shorten our lunch. That'll be good. Let's go ahead and do the primer. Maybe entertain the first presenter if they're here, and just advise the other one we're going to take a short lunch break, and then we'll come back for the second. Would that be okay with you?
That sounds perfectly fine with me.
Then proceed.
I just want to kind of talk a little bit about private equity. Kind of give you some, what is private equity? What is it done, in our economy? Where does it fit in the marketplace? According to the American Investment Council, in 2011, private equity injected over $1 trillion into the U.S. economy. It's become a real force in the economy. In the 2024 public pension study by the American Investment Council, it showed that based on 10-year median analyzed returns, private equity returned 15.2%. The S&P 500 returned 10.23%. 88% of all public pension systems have some allocation to private equity. The size of the private equity market has grown to over 30,000 companies. In comparison, there are currently around 4,700 U.S. publicly traded companies. And that number is down significantly from its peak in the mid-90s of about 7,300 companies. So not having access to private markets would mean that PERS would not have exposure to many of the best investment opportunities there are today. That's fact. So the increased portfolio diversification that private equity has given us, it has been significant in helping pensions grow assets as well as meet actuarial returns. Based on annualized 10-year returns, Mississippi PERS is one of the 10 best performing private equity programs in the country. There's a lot of work that goes into this, and it's done with one of the smallest staffs in the pension community. So right now I'd like to hand it over to Jason Clark to go more in depth on what Mississippi PERS program has done for PERS and the state of Mississippi.
Thank you. Thank you. We have a great lineup of managers coming in. GCM and Pathway are our two fund of one managers, and we have asked them to give a good primer on education, to not just tell about performance and what they do on a day-to-day basis, but have a little bit more of an educational component to it. And in looking through the decks that they've provided, I think that you'll be happy with the presentations. Right now, private equity represents 10% of the overall PERS asset allocation, while currently representing 11.4%, a little over allocated. As a mature program, pacing studies done with the help of Callan, Mississippi PERS program is a mature program, and the expectation is as it continues to mature, distributions will continue to grow, and that allocation will come back in line over the next few years. Our two existing private equity managers represent 9 different fund series dating back to 2008. Over that time, the PERS private equity portfolio has posted a net internal rate of return, IRR, of 15.1%, which is another way of saying that they have averaged 15.1% on an annual basis. with a 1.81 times multiple on invested capital. So another way of saying that is for every $1 we have given them, they have returned $1.81. That's pretty impressive. All of this while distributing over $5 billion back to the beneficiaries of Mississippi. Of that $5 billion, $4 billion is distributions of income and realized gains. The other part being return of capital contributed. In addition to the distributed capital, currently the private equity program has an invested market value of $3.7 billion. So on top of what they have distributed and returned, we still have a market value of over $3.7 billion that is increasing in value and is in the process of gaining. While both programs primarily focus on buyout opportunities, which carry the least risk of the private equity opportunity sets, the two managers are very complementary of one of each other by market cap. Both playing in the mid-market range, industry exposure, everything from government contracts to discretionary goods, while both have consistently exceeded the policy benchmark, performing in the top quartile and top decile. Both managers have significantly outperformed the policy benchmark since inception and have outperformed the S&P 500 significantly over the same period. That's pretty impressive. I'll let them speak to their performance when they come in. Like I said, I think you'll be impressed. The first will be Grosvenor Capital Management, GCM, and we'll have Tom Rest, which I feel you've met before, Lee Brashear, which you've met before, and Mark Roman, which has been in here before as well. Unless there's any questions, I'll retrieve them.
Yeah, I've got one question. Both of the companies appear to be right now in investing and committee stages. So once we make an allocation to them and they start with the investing and committee, about how long is it before we start seeing that return on that particular allocation that they're using?
Well, the life of a private equity investment fund is anywhere from 12 to 15 years. So it depends on the actual investments. Some of them may come to fruition pretty quickly, but most of them are going to take anywhere from 7 to 10 years. They invest in the company, they may change ownership, may change structure, and then you have to let those changes take effect and actually gain in value. Some of them, again, may be quick, some of them may not. And one of the things that I'm happy that they're going to do is GCM's going to talk to a case study as to some of those, specifically one of the funds that they're in. And that's a great question for them to ask them for that specific one and maybe some others that they mention as to the time frame. But most of them are going to be anywhere from 7 to 10 years before they start to throw off significant distributions. And then toward the end, you'll see more and more.
Okay, if I forget to do that,
I'll do it.
All right.
Right.
Any questions on the introductions here? We'll see Grosvenor first.
Yes, sir.
Okay, then they got about, 20 minutes, 25 minutes? How much have you allocated for them in this presentation?
I've told them 30 from an educational standpoint, and then with questions.
That'll be fine. That'll get us right at a good lunchtime.
Sounds good.
Thank you.
Morning.
Thank y'all for coming this morning. We've had a brief introduction, so we're going to turn it over to you all to go with your presentation, and we do have the materials in front of us.
Great. Well, good morning. It's great to be with you again, and hopefully everybody's been staying well since the last time we were together. We appreciate the time, as always, to give you an update on our private equity partnership together, and we also appreciate the overall relationship and partnership between our organizations. As you all likely know, we're in regular contact with your investment team, speaking on a monthly basis about the program, and hopefully they feel the same way as we do, that it continues to be a very collaborative, open relationship and partnership. So we're grateful for that. In terms of the team that works on the relationship, you've got a couple of folks here, hopefully familiar faces. They've been in this meeting a number of times. Lee Brashear and Tom Rest, both managing directors on our private equity investment team. Both have been investing in private equity for decades. Tom is part of a team that is sourcing new managers and funds for Grosvenor and also monitoring those managers. Lee, as well, as part of our investment committee, and he's also co-head of our co-investment team and practice, and so he's very close to that part of your portfolio as well. And I'm Mark Roman, and I'm managing director of the client group, and so I help facilitate things between our organizations. So in terms of jumping in, I know we've got 20 to 30 minutes. We'd certainly welcome any sort of questions you have along the way. It's your time, and so please feel free to interject at any point. I'm just going to real quickly give you a few comments on the firm as a whole, and then turn it over to Lee and Tom. So on page 6 and 7.
Mark, if you would turn that microphone towards you a little bit there.
You bet.
Yeah, thank you. That's even better.
Okay.
Thank you.
So anyway, there's some stats here for you, but the takeaway for you is that Grosvenor's business continues to be very healthy, both from a capital standpoint and from a talent standpoint. So folks like Tom and Lee sourcing and investing capital. We've continued to invest in the team and the business, and so we've seen nice growth as a business where we manage, as you know, we specialize just in alternative investments. We have $82 billion in capital that we manage, and a team of over 550 folks at the organization. We've also continued to see growth, specifically in the private equity practice on page 7, where we manage just over $30 billion in AUM. The team is up to 57 folks. That's just on the investment team on private equity. So we continue to be very active in the market, sourcing deals, as are other institutions. Just our vantage point, we continue to see a lot of institutional investors continue to utilize alternative aspects of the market within their pensions and other investment pools of capital. So we've seen that grow as the private equity market has continued to grow and evolve and ebb and flow with the environment. So maybe on that note, I'll pass it over to Lee to talk about the environment.
Sure. So good morning, everyone. Thanks again for having us and for the long-term partnership that we've had. We're grateful to have PERS as a client and to work with outstanding people like Charles and Jason on a monthly basis. So the private equity market is large, continues to grow. Investors continue to allocate more dollars and a higher percentage of their portfolio to take advantage of the opportunity set. Private companies alone with over 25 million in revenue represent about 45,000 opportunities here in the United States versus about 3,400 that are publicly traded. So a much broader, wider universe of opportunities for private equity funds to choose from. It's been getting more difficult to have a public company, to take a company through the IPO process. Today versus 30 years ago, there's less than half of the number of public companies that there were, and private equity has really stepped in to fill the void and offer opportunities for excess returns from this broader opportunity set. Globally, investors have allocated about 15% of their portfolio to private equity, so very well ingrained, especially with public pension funds. So you're in similar company as you're allocating to the asset class today. Moving to page 10, why do we do this? Number one is really to get higher returns from the asset class, but also to have broader diversification across the portfolio, sizes of companies, types of companies, different ways to create value within those companies. So those really lead to all the reasons why to do this, but number one being to potentially get higher returns. If you look at both of the charts on this page, you'll see that over 10 and 20-year periods, private equity has been able to outperform the public markets. And in buyouts specifically, where we've positioned your portfolio, you've been able to get 250 to 450 basis points of annual return in excess of the public markets. Moving on to the next page with all the bar charts here. So what we've done here is tried to show time periods around the great financial crisis. We're often asked, how to invest in private equity? What's the right deployment strategy? Can you time the market? The answer to that question is no, which I'm sure you've heard before. But what this page attempts to do is to show you that even if you invested in all the years leading up to or going through the financial crisis, private equity has been able to outperform across these different time periods. We also employ a pretty consistent deployment base, especially for your portfolio, to really capture those periods that offer excess performance. So as you can see in the chart on the bars on the right side of the page, kind of the years during and after the financial crisis offered some of the highest potential returns from the asset class. So again, hard to time this, especially mechanically with picking managers, allocating money to the managers, and then those managers allocating money to the deals. But you want to have consistent deployment so that you're invested and you can capture the outperformance when the market offers it to you. So what's going on today on the next page? Uncertainty is going to be the most overused word this year, I think. The geopolitical tensions that are driving a lot of changes for all of us. We have shifting regulatory environment here in the U.S. All this has led to headwinds to growth as well as increased public market volatility. From a private equity standpoint, what that's meant is lower levels of deal activity, lower levels of exits for investors that have existing holdings in private equity. And this has resulted in many large investors being over-allocated to private equity. I think we probably said this when we were here last time, when this has just persisted, continued to increase in a lot of ways. We are seeing some signs that deal activity is recovering, that there is some momentum to get deals done, get exits done, get money back to investors, and keep the cycle going. The larger end of the market has really suffered a larger degree of impact from larger dollars needed to finance big deals. So we've seen lesser activity there. They often need IPOs to actually facilitate exits. Where we focus for you in the middle market, that's really not an issue. But we are seeing signs that recovery is happening and that there's really a pent-up demand of exits that are ready to be facilitated when we get a little bit more certainty on a geopolitical scale. Where do we see opportunities? We've been pretty consistent in our approach. We favor sectors with more resilient demand characteristic, things like consumer staples, healthcare, companies that can flex their market-leading power, pass through pricing from a cost of goods perspective, and that's all held up pretty nicely for us over the last couple of years as we've had a lot of change. We've talked about this before, but family-owned companies continue to need succession plans. So I'll highlight this on a specific investment from your portfolio in a minute, but we're seeing a bigger wave of baby boomers that need succession plans. Private equity has been a key player, especially in the middle market, to facilitate that and to also help these companies grow and kind of get to the next stage of growth in their life cycles. One of the other interesting opportunities in this environment, really stemming from this over allocation and lack of liquidity, is secondaries. So secondaries exist to provide liquidity to illiquid assets, which have often been able to be facilitated at a discount to their current value in order to provide that liquidity. So that's something we think is interesting today and probably has a long tail just based on the gravity of over allocation that we see across the market. On the next page, you'll see a couple of charts just illustrating the trends in new deal activity, starting with the one on the left. So you can see 24, we did see an uptick in new deal volume. We saw that momentum continue in Q1 of 25. Similar trend for exit activity and selling companies getting distributions back to underlying investors that continued through Q1. And then April, global tariffs implemented. Everything really slowed down pretty significantly around April timeframe. But what we do know is there's a lot of companies that are teed up for sale, that are ready for exit once some of the geopolitical and tariff issues, I'd say clear up, but investors and owners, asset owners are really just looking for, what are the rules, what are the guidelines we're operating under, and then we can pursue new deals as well as exits when we know that. The chart on the right shows challenges that fundraising has faced. Amidst all of this uncertainty, private equity firms have had more trouble raising capital. So you can see that the trend looks like 25 will be down from where 24 was. I think this does present an opportunity for those investors with capital to take advantage when the deal volumes come back. So we think we're well positioned with the managers that we're committing to be able to pursue these opportunities while others may not be as competitive. So on slide 14, we thought we would bring one of the investments a little bit more to life from your portfolio, really starting with how did this investment happen from the manager level, what was done, and what were the actual results to PERS. So Falfurrias Capital is the manager that led this investment for us. This is a manager based in Charlotte, North Carolina, that was started by former CEO and CFO of Bank of America. And they built a firm that was focused around hiring C-level operators to really help facilitate value creation within their investments. They were the former owners of Bojangles. So they owned Bojangles through the financial crisis, had a successful exit with Bojangles. And from the experience with Bojangles, they identified condiments as a real thesis that they wanted to go find a company to pursue and help grow. So Sour Brands is a 100-year-old plus family-owned business that was based in Richmond, Virginia, that was the parent of Duke's Mayo. I'm sure everyone's had Duke's Mayo and enjoys watching the Duke's Mayo Bowl like I do from a college sports perspective. But that was a fourth-generation family-owned company that was looking for an exit plan. The existing family members weren't wanting to take over for the next generation, and so they were looking for a new owner who could provide new leadership for the business. And Falfurrias was a great match with their experience, especially with the Bojangles experience that they had. They also had a food executive with close to 40 years experience who had led a major global food company who could really help them look at this business, really understand what the areas for improvement, investment, and then ultimately growth were going to be. So had a really valuable asset with the leadership there. So what they did with this business was, this ended up being really a classic private equity deal, kind of first institutional capital, a lot of low-hanging fruit to create value, things like system upgrades, things like supply chain initiatives, expanding, upgrading the management team of the business. And then they started helping them grow. So they went out and bought some new products. So salsa, popcorn seasonings, really broadened the product portfolio of the business. And then a really key value creation initiative that they started was going to some of these restaurant chains and becoming the private label provider of sauces to some of these big chains with, you know, multi-thousand unit footprint. So that's what really moved the needle in terms of the value creation, and that's all back to their experience owning Bojangles. This investment ended up increasing cash flows about 5 times from investment to ownership just in a little over 5 years. So significant growth in the cash flow of this business at, you know, 5 times the initial levels when they invested. And ultimately, this resulted in a sale this year for over 10 times PERS's investment. So this one resulted in a distribution of close to $17 million for PERS. So a very successful investment, one that is out of the ordinary in terms of the over 10x returns. We're generally looking for about 2 times return at an underlying investment level, but it does illustrate what's possible when kind of all the stars align with the sponsor experience, with the market demand, and you know, was a great result for, you know, for PERS. One thing I'll also say about this manager, I think this manager is one that is very hard to access. So Falfurrias is a fund that when they raise capital, they really don't let any new investors in. So it's very hard to access. It's a manager that we invested with starting 12 years ago. And then a couple funds ago, we were able to get PERS into the fund as we were their largest investor, and we could preserve some allocation to add PERS, which has become one of your top performing managers as well. So I'll stop there. Happy to take any questions on what I've said.
It shows that our investment date was 2019 and it was realized in 2025. That's 6 years. Is that approximately the range of years for the turnover of the investment? Is that how, I mean, is that good, bad, short, long? Tell us about that.
So typically the funds are underwriting for a 3 to 5 year holding period. Now that's what was normal before 2022 when interest rates went up. So today being, you know, just over 5.5 years, I'd say that's still in the range of normal, especially relative to the delay in exits that have forced private equity firms to hold companies even longer than that initial 3 to 5 year view.
Do you happen to have any holdings currently in Seattle, in the Seattle area that you've invested there?
So we likely do. So we've invested in hundreds of funds. So typically we have holdings in every single state.
The reason I ask is we have a meeting out there in August that a number of us are attending, and periodically I just like to drive by and look at the building and see what it is, I mean, if I can get from you the status of it in some manner. So if you have something you want to show off out there, that we could just, if we have an opportunity to just drive by and look at it. It's always interesting to me to look at them if I'm in a large city somewhere.
Yeah, let us come back to you on anything specific, but
why don't you come back to Charles and they can get us the information there.
Yeah, sure thing.
In terms of the fundraising challenges that all these private equity firms are having, I mean, KKR is having the same thing, Warburg's having the same problems as well, I know. Do you see the interest rates, if they do drop them this year, because I know most of these firms have blamed interest rates and companies not expanding. That was a good example with Sauer, which I was aware of, expanding when they expanded. Because most companies expanded after 2008 when things, everything. That's why private equity was able to do what it did. But now with interest rates being high and have been high for a while, less companies are expanding. Therefore, private equity, I've noticed, has held on to a lot of its money and not handed it out to people. Again, they're not expanding or doing any workflow or work-related things. Do you see companies, private equity, getting off that money and using it as companies, as interest rates don't seem to be doing anything, and companies will have to expand to increase profits?
I think what we've seen is the GPs, the private equity firms, were really looking for some stability. So if you look back to even 2014, 15, deals have been done at higher rates in terms of the financing that they've used for some of these deals. So I think really they're just looking for, they don't want to get caught on a significant move short term one way or the other. So I think you've been seeing people waiting for just more stability in rates versus are they going to be up 100 basis points or down 100 basis points? At some level, it doesn't matter as much. It's just that stability that I think people have been really wanting to see. And you've had a continual layering of rates going up in 22, and then, Ukraine war, Russia, you've had just one geopolitical shock after another, just as we've seen momentum start to pick up like we did in Q1 of this year.
Right. Well, then do you see, let's say they don't stabilize, in just your opinion, I mean, let's say we just keep, we were supposed to have 4 rate cuts this year, and then it came to 2, then maybe none. And there is, I guess that is stabilization in some form or fashion. The private equity firms then decide, hey, this is the best it's going to be. And companies decide, hey, this is the best it's going to be. And then we all decide to do something. In your opinion, do you see firms like you all, I mean, is that stability then at that point?
I think this also leads to your point on KKR. So we have, your portfolio is concentrated in middle market private equity.
Right.
And so we have seen good distribution activity last year. This year, Sauer just exited this year. So I think despite what's going on, we've been able to see continued activity in your portfolio that looks kind of normal. If you were over indexed toward larger private equity, I think that's where we are seeing more of the challenges, where those rate the 100 bips one way or the other has a more meaningful impact on getting the financing that you need, and for those companies to potentially go public in a volatile market.
Thanks.
There's been a lot of discussion of private equity in college sports. You were mentioning the Duke Bowl. Is that anything you all are discussing? And I'm curious how you get your money back.
Yeah, so we've seen an increase in funds that are focused on just buying sports teams or sports, and it started with the NFL and then NBA, MLB. So we've seen, I think, all leagues are participating, and as you're saying, now we've started to see people coming down to college level and other leagues, the non-professional leagues too, buying pickleball teams as another example. So we have not invested in any of those strategies to date. I think we are also kind of curious about what are the exit opportunities for those. And you see sticker shock with the Lakers trading for $10 billion this week. Those end up having to be really big deals to facilitate someone getting out of them. So I think questions around liquidity and how do you do that, because there were a lot more incentives offered to individuals owning sports teams from a tax perspective than there are to institutions who don't pay taxes. So, an evolving landscape, but it's one that we haven't gone down that road yet.
Got some facilities that don't miss that could be you. If anybody wants to pump a lot of equity into it.
Thinking that you might want to.
The questions there, just sort of shifting gears from the very granular to the high level. If you look on page 16, so if we go back to the aggregate portfolio that we created with you, so going back to 2009, the program is $2.4 billion over 4 different series. And the question of size, the fund has made just under $2.2 billion in commitments to 114 private equity funds. And those private equity funds invested in 2,100 portfolio companies. Now, about 1,000 of those have been sold over time, the whole period, but there's about 1,100 active portfolio companies in there. So we think performance has been strong, about 1.7 times your money. Maybe jump to the bottom bullet. Now that you have a mature portfolio, your older investments are funding your newer ones. So we sent back $255 million last year, and the new investments you've made drew down $110 million. So can't predict the future, but at this point, typically a portfolio is effectively self-funding. So last year you sent in 110 million, got back 255, so your excess is paying your benefits. So the old funds the new with some excess back to you. As we talk about the size and performance, we've been asked to show the returns a couple different ways, in aggregate, individual series, and using different reporting methodologies, performance reporting methodologies. So some of the numbers won't tie page to page when you go from time-weighted to dollar-weighted returns, but we'll flip through. Maybe looking at page 17, I think in aggregate, the bottom line is the important one. You've funded $2 billion. We've sent back $2.28 billion with $1.2 billion still remaining. So your $2 billion has become 3.5. We expect the newer investments to continue to accrete in value. Very diversified across industrials, consumer, technology, healthcare, financials, largely North America. That's sort of our mandate with you. So it's been 3/4 North America, some Europe, a little other, but primarily a North America buyout mandate. On 18, again, this is the horizon time returns as compared to dollar-weighted returns. And so you'll see your double net, the darker blue, the middle bars over across the 1, 3, 5, and life to date. And the Cambridge median, your current benchmark on the far right corner. So whether it's 1, 3, 5, or inception to date, your portfolio has done quite well, outperforming Cambridge by several hundred basis points. So we think a good, healthy portfolio. Again, this is the time-weighted returns. The next page on 19, you see using the internal rate of return metric, which is a time and dollar-weighted metric. And again, still stacks up quite well. So the second from the left column, the dark one, the double net to PERS, net of all fees and expenses, has outperformed Cambridge by 200 basis points life to date since 2009. So we put in the Burgess, that had been the prior benchmark. We put Burgess in as well. That was a little lower. On 20, getting a bit more granular, we've been asked to provide information series by series as well as an aggregate. So obviously a lot of numbers on the page. I would direct your attention to kind of the medium blue. There's a total for each series. So the 2009 series, we deployed 841 million and have sent back 1.36 billion. There's about 110 million left to be wound down. So this is the tail end of that 2009 portfolio. And you see the breakout between buyout, special situations, growth, and venture. And as you'll note, special situations didn't really turn out the way we wanted. Coming out of the recession, we overweighted special situations. The economy recovered faster and better than we had anticipated. So the distressed debt investments and the turnarounds simply weren't as productive as we would have thought. We have de-emphasized those going forward. But net still 1.3 times your money, 15% annual return for the 09 series. For the below that, the 14 series, again, you've deployed 734 million. We've sent back 810 million. You've got a gain of 651 million. Actually, more gain in the 14 series than the 9. It's younger with more to continue being liquidated. A little higher return, you're at 1.89 and 17% net all in. Going down to the 18 series, a little newer. This is what we call in the value creation stage, the question about hold period. So in the 18 series, we started in 18, it was deployed over several years. So some of the investments are still quite young, as we would find a fund in, say, year 4 of this, and that fund will have a 5 to 7 year hold. So we'd expect those numbers to go up, but I think even at this relatively young point, you've got $169 million of gain on the 487 million deployed. So we think a good, healthy portfolio. We feel good about that one. The 2024 is very, very new. We've invested in 7 funds. You've only deployed $10 million. You've got a gain of 1.4 million, but very early in the deployment stage. We'll continue deploying that for another 2 years. So that runs 24, 25, and 26. So you'll see it spread out across that. And again, the bottom line on everything is total value gain of 1.45 billion. So strong performance, setting back to you 1.7 times. We get a little more granular. We'd asked for series by series. On 22, you'll see very consistent. The diversification across strategy, it's largely consumer discretionary, industrials, healthcare, IT, and financials. Largely North America, in this case, 71% North America. The early series, as discussed with the team at the time, had a bit more weight to Western Europe. That has since been pulled back. So other series have less exposure there. So it's a collaborative decision as we set up the investment guidelines for each series. And again, you see at the bottom, the net asset values. There are 116 million left older assets that are gradually being sold at this point. And the distributions, again, are 1.36 billion. On 23, bit of a tale of 2 stories. So if you look on the far right, investment to date, life to date, very strong. But the past 1 and 3 years look a little weak. And so as we dug into what is happening, you're seeing the tail end of the portfolio has, what's left is about 40% consumers. Some of those were hit pretty hard during COVID. And so there's another slide where you see they're not doing poorly, but it is some degrading investment returns from the COVID impact. Some are still good investments, just not what they were 3 years ago. There was one pet-related business that it's still a 4 times your money deal, but 3 years ago it was an 8 times your money deal. So some businesses that we're seeing diminishing returns of things that spiked in COVID. There were some consumer businesses had supply chain issues, had products. So net still a good program, but you'll see the tail end of that is suffering some on the consumer side. On 24, looking at the benchmark, again, the darkest blue, double net to PERS, still strong against the Cambridge and Burgess benchmarks, about 200 basis points above. 25, you see what I was referring to, a little degradation at both the multiple and IRR. You will typically see a little IRR because of the time weighting factor in there, that at the tail end, things aren't growing quite as much. But in this case, it had been as high as a 1.83, it's at a 1.76. So over the past 3 years, that consumer impact has hurt a bit. But again, still, we think a good portfolio overall. Flipping to 26, the 2014 series, very similar diversification, 80% North America, 18% Europe. It's industrials, it's consumer, it's healthcare, it's financials. So we sort of stick to our middle market buy and build strategy. The performance, very strong here. Again, you can see your middle dark bar stacks up very well against Cambridge over 1, 3, 5, and life to date. The life to date, you're still another 200 basis points above. Current year, it's actually holding up quite well. And again, you've had 800 million of distributions on the amount funded, with still another 500 and some million left. So performing well. Again, on the 14, you see comparison using the internal rate of return numbers, where we're at the 15.2 net of all fees versus Burgess is at 12.3. So strong performance. On 29, you see what I alluded to before. In this case, you see some time degradation on the internal rate of return. However, on a multiple basis, it actually went up a touch in the past year. And so the issue is it went from a 185 to 189, but it's not growing at 20% a year. So you see your internal rate of return time erosion came down a bit. Not that you lost any value, but it's just not growing at the rate it was earlier in its life. We flip to the 18 series, it looks like all the others. Well diversified, the same top 5 sectors: industrial, consumer, IT, healthcare, financials. 80% in North America. So sort of stick to our knitting there. And on 31, the performance, again, looking strong against the Cambridge benchmarks. We're still up a couple hundred basis points over the past few years. So we feel very confident. And this is one where we would expect performance to go up. It's still relatively young. We get the value accretion at the end as they're selling these businesses. On 32, compared to the benchmarks, very strong, 12.2, beating both the Cambridge and the Burgess. And here on 33, you see similar. The actual multiple has gone up in the past year, but you see a reducing increase, so a modest drop in the internal rate of return. Questions on the performance? I know we threw a lot of numbers at you, sliced them various different ways, but happy to explain any of them if it doesn't make sense. I know it's not most intuitive.
So lastly, on slide 35, as part of the 2024 series, we added an allocation to co-investments this time around. And co-investments would be us as Grosvenor on behalf of PERS investing directly into the underlying companies alongside the sponsor. So with the case of Sauer that I mentioned, it would be like if Falfurious came to us and said, we need a little more equity to get this deal done. Can you put some money directly into the deal? And that's what we've done here. This does allow us to invest at a reduced fee rate. So to you, it's roughly about a half fee versus the typical fees of investing in primary funds. So that is attractive. It also, in this case, was a bit opportunistic where we had already created a seeded portfolio that was already written up in value, had been growing at the company level, and you were able to step into this at cost plus interest. So day one, you had an immediate gain when you invested in this portfolio last year, and it's continued to grow and increase in return since then. So today we have 16 underlying investments in this portfolio. We'll ultimately make 25 investments when we're finished investing next year. And so far, we've got about a 24% net IRR on this portfolio. We're shooting for roughly 2 times multiple on this portfolio as well. So a good way to capture this in a seeded way at lower fees for PERS.
Do we have any questions from board members or Alan or staff?
So within your portfolios, we see information technology running anywhere from 10 to 17%, let's say. Is that a deliberate effort to maintain that level of exposure? I know as opportunities come up, you'll take what the market gives you, but as you look across the spectrum of your funds, is that part of your?
We pay attention to diversification, so we wouldn't want to do 5 technology funds out of the 8 we're going to do for a year. So there's not a hard and fast rule that we're going to land at 10, 12, 18%, but we'll want some exposure to technology, but not too much. So we manage it at the fund level. Some funds are diversified. We'll do a little technology, a little consumer, mixed things. Others are pure sector specialists. So we will try to limit what's our best pick. We do bake off or a competitive matrix. professional phrase, where we'll look at, 4 technology funds, and we'll want to say, which one looks the best? And so we'll pick one, rather than do all 3 out of a given vintage year. So I would say soft targets, but not, it came out quite close, probably more luck than design with that thing.
Thank you.
Other questions? Carlos, anything else from this group? We want to thank y'all for coming and presenting. It was interesting. You've done well for us. Continue the good work, overcome all the obstacles, and just double our, no, I'm sorry. That's good. We appreciate the returns on that. So thank y'all so much for coming. Appreciate you coming down.
Thanks for having us. We appreciate it.
Thank you.
Jason mentioned you have lunch coming up. We should have brought you some Grease mayonnaise. Yeah.
order. And we have representatives here from Pathway with us. We have Canyon Lou and Brian Nelson, so I'm going to turn it over to you all then.
All right, great. Well, just want to thank you for providing the invitation to provide an update. Brian, I always enjoy our trips coming down to Jackson. Just by way of quick introduction, I'm Canyon Lou, a partner, managing director in our California office. Been investing in private equity funds for 25 years and at Pathway for the last 21 of those years. Also had the privilege to work on the PERS account since day one, so still remember drafting the original tactical plan for the fund. To my right is Brian Nelson. He's also a partner and managing director in our California office. Brian's been with Pathway for 14 years and has played a key role on your account throughout his career. So this afternoon, plan to provide just a very brief Pathway update. Then I'm going to shift gears a bit and talk about what we do to manage fees. I know private equity fees are a topic on many of your minds, and so I just want to kind of provide a little bit more insight on what we do there. Brian's then going to cover manager selection as far as why it's so important in private equity and exactly how we go about selecting the investments for your portfolio. He's also going to provide a brief market update, and then we'll bring things home with a nice run through of your private equity portfolio. So overall, I'd say private equity performance and deal activity has been relatively subdued over the 2 years since we were last here. But I think as you'll hear today, we continue to feel very good about how the portfolio is progressing, how it's currently positioned. You'll hear that distribution activity has been relatively robust, driven by some pretty nice M&A and IPO events that Brian will touch on. And that performance remains attractive, continues to compare favorably to private equity benchmarks. So with that preview, we can go ahead and dive into the presentation, starting on page 5. Just by way of quick refresher, Pathway was founded in 1991 as a private market specialist. We remain one today. All we do is private equity, private credit, and infrastructure. We don't do real estate or hedge funds or public equity. Private markets are our singular focus. Our assets under management have grown to a little bit north of $95 billion, which we think puts us kind of top 5 globally for what we do. Just as a point of reference, when we were here last, I think we were around $85 billion of AUM, so nice steady growth there. And we continue to invest in the team. We're up to 238 professionals across our 4 offices. And then we'd also note the senior team has remained stable. We've had 1 partner retirement since we were last here. Milt Best, our chief compliance officer, retired at the end of 2023. We've had 1 promotion to partner. Mitch Clemente was promoted to director, the co-head of our secondaries team last year. So net, we are still at 22 partners and owners in the firm. Moving on to page 6, customized accounts and funds of one, like your fund with us, that still remains our core focus. We currently deploy about $7.5 billion per year across our private equity, private credit, and infrastructure strategies into primary funds, secondaries, direct equities, which is how we describe co-investments, and direct credits. Moving on to page 7, just provides a representative investor list. And so, while our AUM is large, we love the fact that we can continue to be able to fit all of our clients onto a single page. Public pensions like PERS continues to represent a majority of our AUM, and we're now up to over 70 of our clients that have been with us for more than a decade. And so want to make sure to thank you for your confidence and continued support in Pathway over these last 17 years. So that was I know it was a really fast Pathway update, but if there are any questions, happy to address those now or at the end. So moving on to slide 9. So we included this section on strategies for fee-sensitive investors because we know, private equity fees are on the minds of a number of our clients, and we know that PERS is fee conscious. And I think it's important for you to know that we are equally fee conscious. We work very hard to minimize the fees that you incur on your investments through a variety of different approaches. We've outlined 5 of those here today. So maybe just to kind of run through those. The first strategy is rather straightforward, which is to negotiate more favorable economic terms. I think most of the attention gets paid to the headline fee, but there are actually a number of different ways we can improve economics through document negotiation. And so just to maybe mention a couple, I think one area is just making sure that we get 100% fee offsets, such that all of the transaction fees and monitoring fees and board fees and other fees that our managers earn provide a dollar for dollar offset to the management fees that we as investors pay to them. We'll also do things like to make sure we get a cap on organizational expenses. We'll also push back on what's considered reimbursable as a partnership expense. For instance, like one area we'll push back on is if our managers want to use private jets to travel. We're fine if they want to do it. We just don't want to pay for private jet travel. So that's something that, an example of where we would push back. Second strategy is to take advantage of fee discounts that our managers provide, typically in the form of a commitment sizing discount or an early closer discount. And so by bundling PERS commitment with that of our other clients' commitments to a fund, PERS can take advantage of these sizing discounts that would otherwise not be available as a standalone investor. Usually you need to be 100 million, 200 million, or 300 million in size to some of these funds to qualify for a fee discount. And those discounts, can be 10 basis points, 15, 25 basis points off the headline fee. So, fairly meaningful discounts there. And then situations where, Pathway has full conviction in a manager, we're also comfortable participating in a first closing in order to take advantage of an early closer discount or fee holiday. Third strategy is to eliminate fees during extension periods. I think a lot of investors just kind of blindly accept fund extension requests that often will have like some type of ongoing management fee associated with them. But I think we take an active role in eliminating fees during these extension periods, just simply by engaging with those managers, well in advance of when those requests will come out. I'd say we don't always win, but we've had really good success getting kind of fees eliminated during extensions. Moving on to slide 10. Fourth strategy is to pursue co-investments and secondaries. So I'd say co-investments provide very direct fee savings as they enable investors to gain additional exposure to individual deals on a no fee and no carry basis. And so since adding co-investments to your portfolio, I think it's been about 9 years ago, you've saved $58 million in fee and carried interest. I'll say that again, $58 million in savings, which is, I think very real and significant fee savings. Secondary investments, I'd say the fee savings are a little bit more indirect, but still quite impactful to you guys. As you may know, secondaries allow investors to purchase a seasoned portfolio of private equity assets, typically at a discount to net asset value, and also without having to bear any of the management fees that have been incurred up until that point in the fund's life. And given that most management fees tend to be more heavily weighted to the early years of a fund, by purchasing a seasoned portfolio, investors are typically able to bypass 60%, 80%, even 100% of those management fees. They'd also mentioned that we as Pathway do not charge a carried interest on the co-investments and secondaries that we put into your portfolio, which is quite below market. So you're getting additional savings there as well. And then the final strategy is to generate strong fee-adjusted returns. I don't think this is so much a strategy, but as a reminder that while fee minimization is important, it's not more important than manager selection and generating strong returns. Private equities is certainly not an area where you want to be penny wise, pound foolish, as I think there's a number of funds where you can get the biggest discounts or the most co-investments, and they're usually cheap for a reason. And so, employing these strategies, I think the savings can be small, but when you spread it across 350 plus investments, it actually adds up to being something quite meaningful. And so, through utilizing these strategies, we're particularly proud of the fact that we've been able to generate for PERS a 15.8% net return. So that return is net of all fees, including pathways.
Yeah. So starting on slide 12, we wanted to spend a few minutes on manager selection in general because of its importance to your program. We think that manager selection is the single largest determinant of success in private equity, and slide 12, I think, does a good job illustrating why that is the case. So what you can see on the left-hand side in the blue bar is the performance spread of what we would call top quartile or bottom quartile managers, or said another way, better performing managers and weaker performing managers. And in the green bar, you can see the same stats for the public markets. And what this illustrates is in public markets, selection matters less. You can select incredibly well, and the benefit that you get from the value of that selection is relatively negligible. And the counter to that is you're not terribly penalized when you select a poor performing public equity manager. In private equity, it's quite the opposite. So your ability to select groups that are likely to outperform in the future can meaningfully add alpha to your portfolio. And conversely, if you select poorly, you are meaningfully penalized for that. And so on slide 13, we wanted to walk you through a bit of how we do that and what that process looks like. In order to go about assessing this broad market, you've got to have a big team of resources. There are thousands of private equity general partners in the world, and in order to go out and find the best performing GPs, you have to be able to fully canvass that market. And so what you can see here is a funnel of the primary opportunities that we reviewed last year in 2024. So as a firm, we reviewed 655 primary fund investments. During that time, we held meetings. We held 580 meetings with 435 of those general partners. So it sort of gives you a sense of the type of work that goes into prosecuting these opportunities. And while a number of those deals fell out pretty early in the process, it was clear that they were not fits. We did a significant amount of work on nearly 300 of those opportunities. And about 30 of those opportunities were brought to our investment committee. Ultimately, we consummated 3 of those deals on behalf of PERS, and so you can see that's effectively a selection rate of less than 1%. And so what that means to us is we are putting your program into what we consider to be the highest quality general partners globally, full stop. And what you can see in the bullets are some of the areas that we focus on when we're evaluating general partners. We're looking for GPs that have strong, repeatable business models, that have incredibly strong management teams, proven access to the highest quality investment opportunities that are out there, and have differentiated resources and skills that they can bring to bear to generate that strong, repeatable outperformance, which is one of the key things that we look for, as you can see in that last bullet. And we're looking for general partners that target markets that have multiple avenues for liquidity, exceptional talent pools, access to high quality management teams, and importantly, in geographies that have reliable accounting and legal systems, stable political environments, and attractive, what we would say is attractive long-term fundamentals in terms of broader economics. All of that said, prosecuting the market is one thing, accessing deals is another, and that's something that as a firm we work incredibly hard at. We're often developing relationships with general partners for 5 or 10 years before they meet our standards for investment. So it is definitely a long-term relationship development process where we work to position ourselves successfully with those general partners to demonstrate that we will be a high-quality limited partner once we get there with an investment. So if there's not any further questions there, I'm happy to touch on the environment. The private equity market has faced its challenges here over the past several years. Taking a step back following, a really strong post-COVID recovery, what we saw was a big pullback in the public markets in 2022. This was particularly noticeable in high growth, low profitability tech companies, and that led to both a meaningful pullback in valuations, but also a sizable gap between buyer and seller expectations. And that had a knock-on effect on distribution activity in the broader market, which has been a meaningful driver of returns historically. while we were starting to see some optimism build in 2024, this was obviously disrupted in the first quarter with the threat of U.S. Tariffs, which dampened market sentiment and also increased volatility and uncertainty more broadly. And this led to a lot of introspective behavior by general partners that temporarily switched their focus from positioning companies for exit to insulating them for potential knock-on effects of tariffs. So think of things like supply chain vulnerabilities, inflation, et cetera. With all that said, there have been both tariff winners and losers, at least on a comparative basis. And I would say in general, private equity appears to be better equipped to endure that instability than public markets. And I would say that's not just due to the long-term nature of the asset class and the active nature of the asset class, but also the composition of the asset class in general. If you look at the majority of the exposure that private equity firms hold, they tend to be in service-oriented businesses and tech-oriented businesses, which are less impacted than, let's say, traditional industrials businesses or automotive businesses, et cetera. And so I would say, despite this increased uncertainty, general partners have continued to find their spots to generate liquidity, and you'll see some areas that are highlighted in your portfolio. This has both been in the M&A market. We're starting to see some green shoots open here in the IPO market as well. I would also say that leveraged credit markets continue to remain accommodative. That has continued to buoy buyout investment activity. If you look at the venture market, while it's broadly remained subdued, we're certainly starting to see some bright spots, particularly related to the rapid adoption of AI technology, which is improving general market sentiments there. Given all these points, the fundraising market in private equity has been incredibly competitive. And so we have seen the amount of capital raised in the market sort of hit its lowest levels in the past, 5+ years.
I'll go ahead and move on to the portfolio update. Page 17 provides a nice snapshot of our now 5 series of capital. So moving left to right through here, the 2008 series is the original series of capital. It was formed in November of 2008. It's nearing completion. It's down to just 250 underlying holdings compared to a peak of nearly 1,500 holdings. Given that this series started during the GFC, it's been a strong performer with a 14.5% net return, which is largely locked in at this point. 2013 series turned 12 earlier this year. It really straddles the value creation and harvesting phases. It's been an outstanding performer with a 17.7% net IRR and a total value to paid-in capital ratio, TVPI, of 2.4x. 2016 series is a bit earlier it's developed than the 2013 series, but it's been an equally strong performer with a 17.6% net IRR. This series continues to progress well through its value creation years, and its TVPI is now up to 2 times paid-in capital. I feel very good about the 2021 series. It made its final commitment earlier this year, and so it's now moved into its investment and value creation phase. It's still relatively young with a dollar-weighted age of just 2 years. But I think we feel very good about this series from a portfolio construction and a quality of manager perspective. We expect performance to steadily progress as this fund starts to enter its core value creation years. And then most recently, we added the 2025 series in April, and a series size equal to that of the prior series. The approach for this series will be consistent with that of our prior series. The only notable change is that we are increasing the amount allocated to secondary investments from 5% to 15% at the request of staff. So on a combined basis, I've now committed a total of $3.84 billion across these 5 series of capital, have a little over 230 primary and secondary investments, and 130 direct equity investments. And so all of that provides exposure to a little bit over 4,700 underlying portfolio companies. The fund as a whole is generating a net IRR, as I mentioned, of 15.8% and a 2.0 times total value to paid-in capital ratio. Page 18 provides a breakout of since inception performance by both strategy and investment type. Looking first at performance by strategy at the top, You can see that performance has been attractive across all four of the fund's core strategies, with buyouts, venture capital, and special situations, all generating since inception returns in excess of 16%. By investment type at the bottom, you can see that primaries, direct equity, and secondaries are also each generating strong since inception returns. Importantly, direct equities and secondaries have been clearly additive to the fund's overall return. Each of those strategies is posting a return in excess of 20%. And this next slide on page 19 provides a summary of annual contribution and distribution activity since the fund's inception in 2008, with contributions represented by the blue bars and distributions by the green bars. There's probably three things worth noting on this slide. You can see that 2021 distributions continue to really stand out. It was just a monster year for distributions with $550 million distributed. And that probably pulled forward some of the distribution activity that we might have otherwise seen in 2022 and 2023. Second thing to note is that, despite the last several years being relatively subdued in terms of deal activity, which you can see reflected in the muted contribution totals in 2022, 2024, and 2025, distribution activity has actually been relatively robust. 2022 and 2024 rank as the second and third best distribution years since this program's inception. And then lastly, comparing the height of the blue contribution bars to the height of the green distribution bars, you can see that the portfolio has been cash flow positive, meaning that annual distributions exceed annual contributions. It's been cash flow positive since 2021. Last year, the portfolio generated nearly $300 million in distributions, which exceeded contributions by over $180 million. I think importantly, we would expect the portfolio to remain cash flow positive from here on out.
So turning to slide 20, what we've done here is highlighted some recent significant exit-related events in the portfolio. All of these are events that occurred either in the fourth quarter or since. We have 12 investments highlighted here, 9 of which have taken place since year-end. This comprises 10 M&A exit events, which generated returns ranging from 1.9 times cost to nearly 35 times cost in the case of Silvus Technologies. That business designs and develops advanced wireless communication systems. It was owned by Resolute 4, which is a fund managed by the Jordan Company, and they sold the business to Motorola for nearly a $5 billion enterprise value, generating a $14.5 billion gain for Mississippi. We also have 2 IPOs here. One in a company called Service Titan, which is a software built for home and commercial contractors to sort of track their service visits and construction projects, keep them running smoothly. This was a company that went public on the NASDAQ in December, and it has subsequently traded up 46%. Through this morning, that had generated a 7.8 times return and a $9 million gain for Mississippi. And we're starting to see the general partner generate liquidity post lockup. They have now returned about $800,000 of that $9 million gain. The second one was a very significant event for the portfolio in a company called Circle Internet Financial. And this company operates a platform for stablecoins and blockchain applications. It was an investment made by Oak 13 back in early 2024, and it went public earlier this month. It has had a monster run up in public markets, which I'll come back to. It priced at $31 a share. The stock is currently trading at $260 a share as of this morning, representing an 8-fold increase from its IPO. And so for the Mississippi portfolio, that has generated nearly an $83 million gain on about a $500,000 investment, representing 185 times return. This is the largest gain since the portfolio's inception. I would note that about 71 million of that gain has come since year-end. So if you were to compare it to what its marks were included in our portfolio, so we'll see a lot of that gain trickle through here in the second quarter It's worth noting, this is a public company. It remains in lockup. It'll have a 180-day lockup period. And so I would expect returns to be relatively volatile from here. Turning to slide 21, this provides horizon performance for the program. As we discussed in the private equity environment slide, the PE market has been challenged here over the past few years, absorbing that decline in valuation multiples, working through that valuation gap between buyers and sellers, and managing through this period of modest exit activity. All of that has led to just broadly subdued short-term returns for the asset class. But as we all know, this is a long-term asset class that is historically managed well through periods of volatility and consistently proven resilient through cycles. And so given that, as we usually do, I would draw your attention to the longer-term time horizons here, 5, 10, and since inception periods. And what you can see there is the portfolio has consistently generated returns in excess of 15% on an annualized basis and outperformed the industry benchmark by a material margin over those long-term time horizons. I think the next slide double clicks on some of that relative outperformance. This is really our scorecard. It's a way of assessing how well we've done in that investment process, that manager selection process that we talked about. It breaks your portfolio down by year of investment and compares your portfolio's return for that year to the industry median for that same vintage. And what you can see is that your portfolio has consistently generated double-digit returns on an absolute basis across all of these years and outperformed the market in every year, dating back to the inception of the program, on average outperforming the market by about 560 basis points. What you can see here is we've disclosed the more mature vintage years, but I will tell you that the more recent vintage years, even though I would describe performance as developing, they are performing quite well. So for 2023 and 2024, the portfolio is generating returns of 14% and 15% respectively. And lastly, on slide 23, you can see that your portfolio continues to outperform its public benchmarks by a material margin. What we've done here is illustrated the incremental gain that you've generated in PPEF 23 versus had you invested the same dollars at the same time in the S&P 500. And you can see on a since inception basis, the portfolio has generated incremental gain over the public markets of more than $510 million.
So just to wrap things up, just want to say thank you. Thank you for bearing with my face. I wish I had a better story, but I got shingles last week. But thank you for your time and attention this afternoon. Thank you for supporting the 2025 series, and just thank you for all your support over these last 17 years. I think it's been, for Brian and I, very fulfilling to have PERS' support over that time period. So I guess what questions can we answer?
Question for me is approximately how long do you anticipate from the time you receive our commitment for your investment and then the returns to begin to happen? How many years on average would that be?
Yeah, so you'll give us, commitments for like the 2025 series, and then we'll commit that into underlying partnerships. And so if we want to talk about the life cycle of a underlying partnership, they typically have a 3 to 5 year investment period is about what we would expect. And then they underwrite deals generally to a 5-year hold. And so investments in year one, we would expect to see some exits as early as, a little bit maybe in year 3 or 4, but I'd say years 5, 6, 7, 8, 9 would be the core years of distributions. And then it's rare that a fund actually wraps up in the 10-year term that they initially proposed.
We're sorry. Your conference is ending now. Please hang up.
All right, who's hanging up?
That's right here.
Go ahead.
And then it usually takes a few more years for them to kind of liquidate those final holdings. So that will be, typically years 12, 13 is when we would kind of expect an underlying fund to exit its final holdings. And the 2025 series, we're going to commit over a 3-year period, so probably add 3 years onto that. I don't know if that was helpful, but that's kind of generally what we would anticipate.
And when you invest in your underlying, your partners and that sort of thing, are there multiple companies that do that? For instance, some of us are going to a meeting in Seattle in August. Would there be a property out there that you might have used our money to invest in that we might be seeing returns or something? Now, you may not know what that is just off the top of your head, but if you have something like that, if you contact staff, sometimes I just like to drive by the buildings and see what you're doing.
Yeah, it's certainly interesting to have a portfolio that invests in lower middle market companies that might have EBITDA of $10 million to some of these giant public companies that everybody's heard of. And I'd say with 4,700 plus holdings, you have exposure to a lot of different segments within the U.S. and probably most states. And so let us know if you're going to be in an area, and we can certainly pull down a listing of the holdings in there if you're
Seattle.
All right.
So
on slide 20, you mentioned very positive about investment in Circle.
Correct.
Where are they located?
Circle. Let me see.
I mean, it's not that important.
They are based in New York City.
Let's skip that one.
It was a. This is coming from a fairly mature fund, and to see such a big spike this late is certainly a positive surprise. But this is quite a notable win for the portfolio.
Other questions for board members, or staff, or Callan representative? Go ahead.
So 2025 series is still in its infant stage. How do you see it changing from 2008, the series, and moving through the life cycle? How do you see the 2025 series changing from previous series, given tariffs, economic uncertainty, geopolitical uncertainty?
Yeah, no, I think it's a great question. I'd say overall our approach to 2025 series is going to be very consistent with the prior series, in the sense that we're very much manager driven. We focus on manager selection, as Brian talked about. And so I think from a portfolio construction and quality perspective, I would expect to see, probably 2/3 of managers, existing managers, that we're going to continue to support. And then we're also looking to add new managers to the portfolio. And I think where you've seen us kind of evolve strategy-wise is we're probably a little more focused on the middle market, lower middle market these days. We just feel like there's more opportunity for returns in those smaller funds compared to the $20 billion funds out there. The other piece that I mentioned earlier is we are going to increase the amount that's allocated to secondary investments. We've been pretty opportunistic with that historically, kind of keeping it in that 5% range. But we agree with staff, this is a nice time to be targeting secondary investments. And we're looking to do up to 15%. When I say up to 15%, that means kind of really what we are trying to target. And so for the 2025 series, we are targeting 15% in direct equity, 15% in secondaries, which we think is a nice complement to the 70% that we'll continue to do in primary funds.
Yes, go ahead.
Can you spend a moment just talking about your strategy allocation with respect to venture, and in terms of how you see that, the guardrails as you look across your history of funds, the exposure to venture capital? Has it been within certain levels, or is it truly just bottom up, opportunity by opportunity?
You want me to take that, or do you want
Yeah, I'm happy to take it. The punchline is our strategy there remains consistent. You're right. We are generally looking at every opportunity on a bottoms-up basis. So when a venture opportunity is brought to our investment committee, it has to stack up well to venture capital deals, but it also has to look just as good as any other opportunity that we're looking at, be it buyouts or special situations. For the PERS portfolio, we have consistently held a target range for venture exposure of between 10 to 30%. And that band allows us to be opportunistic to deploy capital into the highest quality general partners as they come to market. And we've been relatively consistent across each of the series, ranging anywhere from 16 to 25% of exposure on a committed capital basis. And so I would continue to expect that to remain consistent. What we have seen others do in the market over time is chase fads, and we've seen how that has played out. And AI is certainly one of those areas where I think you're going to see a lot of very strong gains generated, but you're also going to see a lot of capital destruction. And so what you won't see us do is deviate from our strategy to chase the latest fad or, where the balance of capital is moving in the market. We're going to continue to stick to our knitting.
Yeah, and John, I just added, the target range is 10 to 30%. I think realistically, we're not going to end up anywhere near 30%. I think when we look at the opportunities that are currently in the market, I think it suggests more of a 15 to 20% type of range. I think the one thing that we're really cautious to do is not force capital into venture capital, just because there's a highest quality venture capitalists out there, and I think they have the access to the best deals. And then if you go down to that next tier, I think you see quite a bit of degradation in performance. And so a long way of saying that I think, overall, we're probably trending a little bit lower in venture, but no change in approach. I think we probably will turn over one or two of the venture managers in your portfolio just based on performance that's been okay, but I don't think quite strong enough.
Thank you.
Any other questions? Well, Canyon, Brian, appreciate y'all coming down. Are y'all both out of the Irvine office?
We are. You should come by and visit us anytime.
Well, I'm just glad that you came on one of our cooler days. Today it's not quite 100, feel like. I was mowing the grass Friday and it was like 110 at my house. So, the weather has cooled off for you. So
We appreciate that.
I was telling Jason that I'm flying to Boston from here, and it's gonna be hotter there, and I didn't expect that to be the case. So I appreciate the cooler weather, but for us Californians, this is plenty warm.
Thank y'all so much.
Thank you all.
Thank you.
Appreciate your work.
Thank you. Thank you.
There are some miscellaneous updates. I'm going to have Jason cover them because one of them he had great influence over. So, Mr. Clark.
Thank you. We have two miscellaneous updates. The first one being Principal Capital Management, one of our core real estate managers. We have taken advantage of a fee break at $750 million. In looking at the concentration risk that presents, we have wanted to rebalance that. They helped us with that, and with a little bit of encouragement to lower the fee break from $750 million down to $500 million, and also lowered the fee at $500 million from 73 basis points down to 70. So we're actually getting a 3 basis point discount and having the opportunity to rebalance that concentration risk within Principal, the core U.S. Property Fund. That's a very, very good thing for us, and we're looking forward to taking advantage of that. The second one is UBS's TPF. Y'all have had the opportunity to hear Paul Canning speak before this board a good many times over the years. Paul has been a key person in the UBS real estate office for over 25 years. He is retiring as of July 1st, and taking his place is Larissa Belova. Larissa comes to UBS as the Chief Investment Officer after having served as the head of CBRE's core real estate program, a flagship program for CBRE, a very good CBRE core real estate program. She will take over as of July 1st, and having spoken with her a few different times, I think that while we will miss Paul, I think Larissa will do a very good job in continuing to right that ship and continue to beat the benchmark as time allows.
We appreciate the work on the fee decrease.
Yes, sir.
As always. You noted that, Commissioner, fee decrease.
Yeah, I read that as 0.07%, and you usually won't see something going down. So whoever's responsible for that, well done.
Right there, sir.
Jason did that, I think, mostly. Charles, anything else?
That is all I have, sir.
No, sir, nothing else. Thank you.
Anything else from other board members? Callan, you need to warn us, inform us of anything else?
No, sir.
Dow was up 500 points. Could we get the governor to declare today June 30th?
That's right, that's right. I agree. I agree.
Okay. I like
Should modify the fiscal year, that's right.
What time in the morning?
10 o'clock, 10 o'clock in the morning.
10 o'clock in the morning, Investment Committee is adjourned. See y'all then.